Welcome to another FAR walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over FAR Area 2, and this is Section I. This is an application topic. Prepare journal entries to recognize equity transactions in the financial statements, and we're going over Treasury stock today. Remember, in the previous video, we talked about equity issuance, stock dividends, and stock splits, and now we're continuing that blueprint topic and talking about Treasury stock. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. If you don't know much about our strategies, make sure you check out our free 1-hour webinar training on SuperfastCPA.com. Sign up for that because we will teach you the key ingredients to passing the CPA exam in just 1 hour for free so that you don't waste months or even years of your time failing these exams. So make sure you check that out. And after you watch that, you'll probably want to learn more, so make sure you also check out becoming a SuperfastCPA Pro member. SuperfastCPA Pro members get access to the Pro course, which is where we explain super in-depth every single detail of how you should study every day, all the way until you finish the exams. So again, the Pro course is the big reason why you want to become a Pro member, but also Pro members get access to the full 10-question versions of these 5-question YouTube videos. So again, Pro members of SuperfastCPA get access to the full videos where we go over more questions so that they can get more practice and more understanding. So if you like this and you like our other products and our other videos, make sure you check out the webinar and make sure you check out becoming a SuperfastCPA Pro member. With all that said, let's dive straight into the questions. All right, here we are at question 1, and something we always like to point out with these questions, and I do it every video, is that you want to read the last part of the question first. When you're doing these questions all in a row, it might not seem necessary, but it is a very good habit to be in for test day, because on test day, you're going to be seeing questions on a whole bunch of different topics, and hopefully you've studied all of them right, but you have no idea what you're going to be seeing. So reading the last part of the question first gives you context and gives you an idea of what you are looking for throughout the rest of the question so that you can more quickly find what you actually need in the question to figure out the correct answer. So you read the last part to give yourself context instead of reading the whole question first and then getting to the very end and realizing, oh, this was a treasury stock question or whatever the case is. So again, read the last part first. That will give you context and help you go through questions more quickly. Let's read the last part here. How much should XYZ Corporation debit or credit to the additional paid in capital, or APIC, account for the repurchase transaction? Okay, so we're dealing with a repurchase. XYZ Corporation initially issued 1,000 shares of common stock at a par value of $10 per share for $15 per share. A year later, the company decided to repurchase 200 shares at $18 per share using the par value method. So again, with that information, we have to figure out what the debit or credit is to the APIC account for this repurchase of stock. So of course, we're going to be dealing with treasury stock throughout this whole video, so I'm not going to, pretend that we're not dealing with that. But what is the journal entry for this? What does this look like? How do we know what the debit or credit is going to be for the APIC account? If you have any idea how to do this, that's great. Pause the video and do this yourself. If you've never really seen this or you don't remember how to do it, that's okay as well, because we're going to dive straight into the answer to learn how to do this. Remember, we are using these questions to teach us how to do the questions so that we can then do well on test day. So let's go ahead and look at the answer if you haven't already paused the video yet. All right, here we are. The answer is A, you would debit APIC for $1,000. So let's walk through this. And by the way, throughout the whole video, we're going to be going over the journal entries for every single transaction. So we're always going to go over the issuance of stock journal entry, and then we're always going to go over whatever other journal entries there are, because I want this to sink in. I want you to remember how the journal entries work for these situations. So let's go through this. When you issue stock, remember, we talked about this in the previous video. This hasn't really changed very much. You debit cash for the amount that it was actually issued for. So 1,000 shares were issued for $15 per share. So that's $15,000 of cash debited. But then you credit common stock for the par value. You do not credit common stock for the same $15. You credit it at par value. So that's $10,000. So there's a $5,000 difference in the credit balance. So we have to do the other $5,000 to additional paid in capital. Now, one thing that I want you to get in the habit of when it comes to treasury stock, or maybe just in general, but especially when it comes to treasury stock, when you're doing the par value method, you want to pay attention to how much the APIC is per share. And what I mean by that is, yeah, the APIC is just the difference. It's just 15,000 less 10,000, that's $5,000. But we also want to know how much it is per share, because that will come in handy in the next calculation. So $5 of additional paid in capital per share is what happened after this issuance of stock. So we're going to use that in just a second here. Now let's go down to the repurchase of stock. This is where the treasury stock comes in. They repurchased 200 shares at $18 per share. So they spent, again, $18 per share for 200 shares to buy back their own stock. And since they're using the par value method, that's where this additional paid in capital per share comes in. Let's go down to the journal entry. You debit treasury stock for how much the par value is. So you debit 200 shares at $10 par value. So with the par value method of treasury stock, you do not record treasury stock at how much it cost to buy the shares back. You record treasury stock at the par value of those shares that were repurchased. And then you also debit additional paid in capital for the same shares at the amount of additional paid in capital that each share was worth from the initial issuance of the stock. So that's where this $5 of APIC comes in. So in this situation, additional paid in capital is not just the difference. It is taking this $5 of additional paid in capital per share, which was the difference from the issuance, but you take that amount and you apply it to the shares that were repurchased, and that gives us $1,000 that goes to additional paid in capital. But if you'll notice, we go down to cash, which this was the amount that they actually paid to get these shares back. It was 200 shares, and that was where we used the purchase price, the $18 per share. So cash was $3,600, but if you'll notice, we debit treasury stock $2,000, we debit additional paid in capital $1,000, and we credit cash for $3,600. There's still $600 left, and that is where we debit retained earnings. And in this case, retained earnings is the plug instead of additional paid in capital. It's the cash less the treasury stock less the additional paid in capital. This is how you do a stock repurchase or, a treasury stock repurchase when you're using the par value method. With the par value method, you are recording treasury stock at par value. You are paying attention to how much additional paid in capital was worth per share when the stock was initially issued. And then you are using retained earnings as the plug. And that's the difference between how much you paid to repurchase the treasury stock and then, taking into account the treasury stock at par value and the additional paid in capital per share that you had from when you issued the stock. So again, the retained earnings is the difference there. So that's how you do the journal entry for repurchasing stock under the par value method for treasury stock. Now let's go to the next question to learn a little bit more about the par value method with treasury stock. All right, here we are at question 2. How much should Bright Horizons Inc. debit or credit to the additional paid in capital account for the reissuance transaction? So similar question, but now we're dealing with a reissuance of treasury stock. So let's go up to the top here. Bright Horizons Inc. was organized at the beginning of the year by issuing 4,000 shares of common stock at a par value of $6 per share for $10 per share. So they sold them for $10 per share. Later in the year, the company repurchased 800 shares at $12 per share using the par value method. Near the end of the year, Bright Horizons Inc. reissued 500 of these treasury shares at $11 per share. So similar to the previous question, but now we're adding in, they are reissuing some of that stock that they repurchased. They're reissuing some of their treasury shares. So again, with all that information, we have to figure out what the debit or credit is to the additional paid in capital account for the reissuance. So far, you've already in the first question, you know how to do the issuance and you know how to do the repurchase, hopefully, right, with the treasury stock. But the question is, how does the reissuance work? If you have an idea, pause the video, or if you have a guess, again, try this on your own. If you don't know how to do it though, that's okay. Again, we are using these questions to learn how to do this. So let's go ahead and look at the answer if you haven't paused it already. All right, here we are. The answer is B. You would credit additional paid in capital for $2,500. So let's walk through this. Again, we're going to go through each of the journal entries just to kind of help it sink in and remind you how we get to the ending amount. So first off, they issued stock. They issued 4,000 shares at $10 per share. And so we debit cash for that $10 per share for the 4,000 shares. So that's $40,000 of cash that they debited. But remember, they do not debit common stock for the same amount. They only debit common stock at the par value. So 4,000 shares at $6 par value is $24,000. And then the additional paid in capital is the difference. That's $16,000. But remember, with the par value method for treasury stock, you take that difference, 10 less 6, and that's actually $4 of additional paid in capital per share. So $4 of additional paid in capital per share, we're going to be using that in the next journal entry. So let's go to the repurchase of the stock. They then bought back 800 shares of this. And since we're using the par value method, they record the treasury stock at par value. And so 800 shares at $6 of par value is $4,800 of treasury stock. Remember, the additional paid in capital for this is actually 800 shares at this $4 additional paid in capital per share amount that we got from the issuance of the stock. So that's $3,200 of additional paid in capital. And then we go down to the cash, that's $9,600. And that is where it was 800 shares at the $12 purchase price. So $9,600. So you'll notice there is a difference here of $1,600 that goes to retained earnings. So we debit treasury stock, we debit additional paid in capital, we debit retained earnings. And again, the retained earnings is the difference the amount that is not covered by the treasury stock and the additional paid in capital, and then we credit cash. And then finally, now we get to the thing that we have to figure out, but we had to do these ones first. We go to the reissuance of the treasury stock. When you reissue treasury stock using the par value method, you debit cash for the amount that it was reissued for. So, the shares were issued at $11 per share. So we do still debit cash normally like that. So that's $5,500 because 500 shares at $11 per share is $5,500. We credit treasury stock still at the par value. So remember, with all of this, I think this is the easiest thing to remember. When you see par value method, remember that treasury stock is always recorded at the par value. Whether you are debiting treasury stock from the repurchase or you're crediting treasury stock from the reissuance, you do it at the par value. So 500 shares at the $6 par value is $3,000 of treasury stock that's being credited. And then you know that there is a difference between $5,500 and $3,000, and that is the additional paid in capital of $2,500. So the additional paid in capital per share from the issuance of the stock only matters for the repurchase of the stock. You're not then using it also in the reissuance of the treasury stock. When you reissue the treasury stock, you do additional paid in capital kind of as the plug. It's the difference between the repurchase cost and the reissuance price. So that is how you do the reissuance of treasury stock with the par value method. We went through all of the journal entries. So as you go through these questions with me, pay attention to the journal entries. I want these to stick in your brain. They're pretty similar most of the time, but of course you always want to make sure that things balance. So pay attention to that. But that is how, again, you do the treasury stock repurchase and reissuance under the par value method. Now let's go to the next question to learn about a different method. All right, here we are at question 3. What is the correct journal entry Riverside Corporation should record for this repurchase of treasury stock using the cost method? Okay, so now we're using the cost method, not the par value method. Riverside Corporation initially issued 3,000 shares of common stock at a par value of $4 per share for $9 per share. Mid-year, the company repurchased 1,200 of these shares at $11 per share using the cost method. So with that information, again, we have to figure out what the correct journal entry is for this repurchase using the cost method. Now, the cost method, again, kind of pay attention to the name. I think you could probably figure this out just based on the par value method meaning what it meant and what the cost method probably means. So give this a try, pause the video, think through this, and when you're ready, come back. We will look at the answer together. All right, here we are. The answer is A. You would debit treasury stock for $13,200 and you would credit cash for the same amount, $13,200. So the cost method is a little bit easier, in my opinion, than the par value method. But I think the par value method is used a little bit more, but I still wanted to make sure you knew what the cost method was. So let's go through this. The cost method records treasury stock at the price paid to repurchase it. So this is probably what you would initially kind of naturally think you would do with treasury stock until you learned what the par value method is. But now we're doing the cost method, which again, you record it at the price that was paid to repurchase it. So it's pretty easy. So we go, as always, to the initial issuance of the stock because sometimes this does give us very important information. We debit the cash, which was because it was 3,000 shares at $9 per share for $27,000. We credit common stock for $12,000 because you record common stock at the par value, 3,000 shares at $4 par value. And then you credit additional paid in capital of $15,000. And remember, this is just the difference. And you'll notice in this situation, we don't have to pay attention to what the additional paid in capital is per share. It would be $5 in this case, but we don't need that because when it comes to the cost method, you'll see with the repurchase, we didn't actually need it. So let's go down here. For the repurchase of stock using the cost method, they repurchased 1,200 shares at $11 per share using the cost method. Under this method, the treasury stock is recorded at the actual cost paid to repurchase the shares. So we don't have to worry about the additional paid in capital. We don't have to worry about debiting retained earnings. It's a lot more straightforward. You just debit treasury stock for how much it costs to buy back that treasury stock. So 1,200 shares at $11 per share, that's $13,200. And that is how much it costs to get the stock. And that is how much the treasury stock is debited for. And that's how much the cash was credited for. So again, the key points of the cost method. The treasury stock is recorded at the cost paid to repurchase shares, not at the par value. There are no adjustments to APIC or retained earnings at the time of the repurchase under the cost method, as all entries relate directly to the cost paid. So again, cost method, more simple, more straightforward. As far as the repurchase, you just record treasury stock at how much it costs to get the treasury stock back. You don't have to worry about the par value. You don't have to worry about the additional paid in capital per share from the issuance of the stock. You don't have to debit retained earnings for the difference. You just debit treasury stock for the amount it cost and you credit cash for that same amount. So with that, now let's go to the next question. All right, here we are at question 4. what is the correct journal entry for the reissuance of the 500 Treasury shares? Okay, now we're doing another reissuance question, probably with the cost method. Let's go up to the top. Greenfield Solutions initially issued 2,500 shares of common stock at a par value of $2 per share for $10 per share. Later, the company repurchased 800 of these shares at $12 per share using the cost method. At the end of the year, Greenfield Solutions reissued 500 of the Treasury shares at $15 per share. So again, with all that information, we have to figure out what the journal entry is for the reissuance of the 500 Treasury shares using the cost method. Remember, the cost method was pretty easy for the repurchase. Now we just have to figure out what the reissuance looks like. So pause the video if you want, kind of think through what we've learned in the previous questions, give this a guess, and when you're ready, come back, we will look at the answer together. All right, here we are. The answer is A, you would debit cash for $7,500, you would credit Treasury stock for $6,000, and you would credit additional paid-in capital for $1,500. So let's walk through this. As always, we're going to do each of the journal entries. For the initial issuance, this is something that hasn't really changed throughout the video. You debit cash for the amount that the shares were purchased for, so $10 per share, 2,500 shares, that's $25,000. You credit common stock for the same amount of shares, but at the par value, and you credit additional paid-in capital for the difference. And remember, with the cost method, we don't have to pay attention to how much the additional paid-in capital was per share. In this case, it would have been $8 per share, but again, we don't have to do that. Now, if you want to be in a good habit because you can't quite remember how it works and you want to just make sure that you have the information you need just in case, you can pay attention to that, but it's pretty easily calculated. Again, you just take the $10 from the issuance cost and the $2 par value, and the difference is $8 per share. So with that, we go to the repurchase. Again, remember with the cost method, the repurchase of Treasury stock is not that difficult. You just record it at the 800 shares that were repurchased at $12 per share because that was the purchase price, and it's $9,600. That's all you have to do there. Not too bad. Now let's go down to the reissuance. This is a little bit different than the par value method for reissuing Treasury stock. They reissued 500 shares at $15 per share. So what do? We go down to cash. We debit it for the 500 shares at the $15 per share that they were reissued for, so $7,500. We credit Treasury stock for the 500 shares at the $12 cost per share. So in this case, again, we're not using the par value. We are going back to the $12 per share that they were purchased for, that they were repurchased for, and then we are crediting Treasury stock for that same amount per share. So 500 shares at the $12 cost that it cost to repurchase those shares when they repurchased the Treasury stock, and that's $6,000. And then the additional paid-in capital is, again, the difference. So $7,500 less $6,000 is $1,500. So that is how you do the repurchase and the reissuance of Treasury stock under the cost method. We also talked about the par value method for those as well. Now let's go to the next question. All right, here we are at question 5. What is the correct journal entry Atwood Corporation should record for receiving the 500 shares back from the shareholder? Okay, so this is a new journal entry, something we haven't quite talked about yet. Atwood Corporation issued 2,000 shares of common stock at a par value of $5 per share for $20 per share. During the year, one of the shareholders, due to financial difficulties, decided to gift 500 shares back to Atwood Corporation without any payment. Atwood Corporation will hold these shares as treasury stock and typically uses the par value method for recording treasury stock. At the time of the gift, the shares had a fair market value of $22 per share. So again, with all that, we have to figure out what the journal entry is for when these shares are given back to the corporation from the shareholder. This is something we haven't really gone over yet, and it's different than what we've talked about. So if you don't know how to do it, or you don't really have an idea, that's okay. We're going to look at the answer to understand how this is treated. All right, here we are. The answer is A, you would debit treasury stock for $11,000 and you would credit additional paid-in capital for $11,000. So let's walk through this. When shares are voluntarily returned to the corporation without compensation, so the corporation didn't have to buy it back, they are usually recorded as treasury stock at the fair market value on the date of donation, not at the original issuance price or the par value. Now, I think I've seen somewhere that there are sometimes situations where this isn't the case, but as far as the CPA exam goes, it looks like most of the time or all the time you're going to be dealing with when there's donated shares or shares that are given back, it's recorded at its fair market value as of the date of the donation. So let's go down here. Remember the initial issuance of the stock. They issued 2,000 shares at $20 per share, so that was a debit to cash for $40,000. They credit common stock for the 2,000 shares at the $5 par value, so that's $10,000. And then you credit additional paid-in capital, $30,000. And you might have gotten a little bit tripped up where it says they usually record treasury stock at the par value or using the par value method. You know, I put that in there just to kind of make you think maybe it's still using the par value method, but in the end, you actually don't need this $15 of additional paid-in capital per share. because you don't use the par value method when you're doing donated treasury stock. So what do? The journal entry for this is you debit treasury stock or donated treasury stock, however you want to put it, for the 500 shares at the $22 fair market value per share. So that's $11,000. And you actually credit additional paid in capital for $11,000. You're not crediting cash because you didn't have to pay for it. You're not crediting retained earnings because you're not having to take money out of retained earnings to do anything, or you're not adding money to retained earnings. Again, these are just shares that the company's getting back as treasury stock without having to do anything for it. So that's why you debit treasury stock and you credit additional paid in capital. So that is how you do the journal entry for donated or gifted back treasury stock. You just debit the treasury stock for the fair market value of the shares, and you credit additional paid in capital for that same amount. And with that, we've gone over a lot in just 5 questions, a lot of journal entries. Before we go any further, let's do one more part of the process called pillar topics. Now, the idea behind pillar topics with SuperfastCPA is as you're going through the questions, you will notice the things that keep popping up. You've seen 3 or 4 questions trying to teach you how to do the par value method for the reissuance of stock, or you've seen 2 or 3 questions trying to teach you about the cost method, or whatever the case may be. You are noticing these things throughout the questions. You're not focusing as much on questions that are like a one-off question that you only see something once. Again, you're focusing on the themes, the calculations, the things that are popping up throughout multiple questions as you are doing the questions that day. And during or after your study session, you take a moment and you write down these important things that you've noticed as pillar topics in your own words. And as you do this each day, you are building a personal repository, your own personal condensed notes on the most important things you need to know for the exam based on the questions. And again, what are you going to be doing on test day? You're going to be answering multiple choice questions. So that's why we do it this way. So with that, let's go ahead and look at the pillar topics for this video. All right, here we are at the pillar topics. Let's go ahead and just dive in. And I kind of just did a pillar topic for each of the entries that we learned about. So the journal entry for repurchase of treasury stock using the par value method. Under the par value method, treasury stock is recorded at its par value with any excess cost debited to additional paid in capital. And remember, with the par value method, you are figuring out from the initial issuance of the stock how much the additional paid in capital was per share. And you use that. And once that's used up, the remaining deficit is debited to retained earnings if the APIC is insufficient. And then finally, of course, cash is credited for the repurchase price. Now let's go to the next part here. The journal entry for reissuance of treasury stock for the par value method. When treasury stock is reissued under the par value method, the par value again is credited to the treasury stock. So for each time you are using the par value for the treasury stock, and any difference between the reissued price, which is debited to cash, by the way, and the par value is recorded in additional paid in capital. Now moving on to the journal entry for the repurchase of treasury stock using the cost method. It's very simple. You just record the treasury stock at the price that was paid to repurchase the treasury stock. You don't need to adjust additional paid in capital or retained earnings. You just have a debit to treasury stock for the purchase price and a credit to cash, or maybe something else, but usually cash for the repurchase price. And then for the journal entry for the reissuance of treasury stock under the cost method. For reissuance under the cost method, treasury stock is credited at its repurchase cost, and then however many shares are, being resold, that will give you the amount of treasury stock that's credited, with any gain credited to additional paid in capital or any loss debited to additional paid in capital, or to retained earnings if additional paid in capital is insufficient, which actually, I don't know why I put that there. Sorry, that part I don't think that's necessary. Again, the difference is debited or credited to additional paid in capital, and then the cash is debited at the reissue price. So however much the reissue price was, that's how much cash you're going to be getting. And finally, the journal entry for donated or gifted stock to a corporation. When stock is donated back to the corporation or gifted back to the corporation from a shareholder who had, stock in the corporation, it is recorded as treasury stock at fair market value on the donation date, with an offsetting credit for additional paid in capital, resulting in no net change for stockholders' equity. So we didn't really talk about that very much, but think about it. There's no real change to the equity when stock is donated back to the corporation. You're debiting treasury stock, which is a contra asset, but you're also crediting additional paid in capital, so it kind of offsets itself. So with all that, we went over the pillar topics for this video. Again, we learned a lot in just 5 questions. And before you go, make sure you check out our free 1-hour webinar training on SuperfastCPA.com. Sign up for that because we will teach you the key ingredients to passing the CPA exam without wasting months or even years of your time. And I think you'll want to learn more about SuperfastCPA after you watch that webinar. So make sure you check out becoming a SuperfastCPA Pro member, or of course getting the total bundle. But if you become a Pro member, you get access to the Pro course where we walk through the whole strategy, step by step, exactly what you should be doing every day to pass these exams. And we also give you access to the full 10-question versions of these 5-question YouTube videos. So again, Pro members get access to the 10-question versions of these videos so that they can get more practice, a little bit more understanding, and a little bit more help with these topics. So again, if you like this, check out the webinar, check out becoming a SuperfastCPA CPA Pro member. And with all that, I hope this was helpful. I hope you liked the video. If you did like it, make sure to like it and leave a comment. And I will see you in the next video.